You don't need an army to change a country. You don't even need a new law. All you need is credit. Because the moment a bank approves a loan, it doesn't just create money, it quietly reshapes the future. Not metaphorically, mathematically. And once you see how credit actually rewires an economy, you can't unsee it. Right now, global debt sits above $300 trillion. Governments owe, corporations owe, households owe. Entire growth models are built on borrowed time. But the real story isn't how much debt exists, it's where it flows. Because credit is not neutral. It doesn't spread evenly. It doesn't reward everyone equally. It behaves more like electricity. It flows toward what the system incentivizes. And wherever it flows, that part of the economy grows stronger. Everything else slowly fades. That's how entire economies get rewired. Without headlines, without revolutions, without anyone voting on it. Let's start with something simple. When a commercial bank gives you a loan, it doesn't hand you someone else's savings. It creates new money digitally. A new deposit appears in your account. Simultaneously, a loan appears on the bank's balance sheet. New asset, new liability, new money in circulation. Multiply that process millions of times, and you don't just finance activity. You expand the money supply itself. But here's the detail most people miss. Banks are not required to lend into the most productive parts of the economy. They lend where risk-adjusted returns look safest and most profitable. And historically, that has meant one thing more than anything else: assets, real estate, stocks, existing financial instruments, not new factories, not risky innovation, not long-term productivity upgrades, assets. Now imagine what happens over 20 or 30 years if most newly created money flows into buying existing assets instead of building new productive capacity. Asset prices rise. Owners of those assets get richer. Collateral values increase. Banks feel safer lending even more. It becomes a feedback loop. Higher prices justify more credit. More credit pushes prices higher. And quietly, the structure of the economy shifts. Housing becomes less about shelter and more about leverage. Corporations borrow to buy back shares instead of investing in expansion. Financial engineering becomes more profitable than physical production. No conspiracy required. Just incentives. Let's rewind to the 1980s. Credit markets were deregulated across major economies. Interest rates fell from historic highs. Financial innovation accelerated. Global capital flows expanded. Credit became cheaper, easier, faster. From that point forward, debt began growing consistently faster than GDP in most developed countries. That ratio matters. If total debt grows faster than total income for decades, it means future income is increasingly pre-committed to servicing yesterday's borrowing. And here's where the rewiring becomes structural. When households take on large mortgages, more of their monthly income goes to debt payments. That reduces discretionary spending elsewhere. When governments carry heavy debt loads, tax revenue increasingly funds interest payments instead of infrastructure or public services. When corporations prioritize debt-financed buybacks, executive compensation rises alongside stock prices, but long-term wage growth stagnates. The economy still grows, but it grows in a different shape. More finance, more asset inflation, less broad-based productivity growth. And because rising asset prices make people feel wealthier, the system looks healthy on the surface. Until credit slows. Credit growth is the oxygen of this structure. As long as new loans expand faster than old loans are repaid, liquidity increases, asset prices remain supported. Confidence stays intact. But if credit expansion decelerates, not even collapses, just slows, the math tightens. Asset prices wobble. Collateral values fall. Banks tighten standards. Borrowers retreat. And suddenly, an economy built on expanding balance sheets confronts contraction. This is why financial crises rarely begin with a dramatic event. They begin with a subtle slowdown in credit growth. In 2008, U.S. housing credit stopped accelerating. That was enough. The entire system, layered on mortgage-backed leverage, began to unwind. It wasn't just a housing problem, it was a credit structure problem. Now zoom out globally. Emerging markets borrow in dollars. Corporations issue bonds internationally. Sovereigns refinance constantly. Global liquidity conditions, often influenced by the U.S. Federal Reserve, ripple outward. When dollar credit expands, capital flows outward. Asset prices in developing economies surge. Construction booms. Growth looks miraculous. When dollar liquidity tightens, the reverse happens. Currencies weaken. Debt burdens rise in local terms. Capital flees. The wiring flips polarity. And none of this requires malicious intent. It's embedded in how credit is priced and distributed. Here's the uncomfortable math. If an economy relies on debt to grow, and that debt carries interest, then future growth must be sufficient not only to sustain current living standards, but also to service expanding interest obligations. If growth slows while debt remains high, a larger share of income shifts toward creditors. Quietly, systematically, this is where power dynamics emerge. Creditors gain leverage during downturns. They dictate restructuring terms. They prioritize stability of repayment over redistribution. Debtors, whether households or governments, become constrained. And because credit creation largely happens through private banking systems, capital allocation reflects financial incentives more than democratic priorities. Public narrative says markets allocate capital efficiently. Underlying reality says markets allocate capital according to collateral strength and expected return. Those are not always the same thing. Consider housing again. When property prices rise faster than wages for decades, younger generations must take on larger debt burdens just to access shelter. Their economic lives begin with leverage. Their consumption patterns change, their risk tolerance changes. Their political priorities change. Credit doesn't just fund transactions. It shapes behavior, and behavior shapes the economy. There's an irony here. Credit expansion often begins as a solution to stagnation, lower interest rates, easier borrowing, stimulus through lending. Short-term relief, long-term dependency. The more an economy relies on expanding credit to sustain demand, the more sensitive it becomes to interest rate changes. That's why central bank rate hikes feel like shock therapy, because in a highly leveraged system, small changes in borrowing costs cascade quickly. Mortgage payments adjust, corporate refinancing becomes expensive, government deficits widen, and suddenly, policy space narrows. So what does this mean long-term? If credit continues flowing primarily into asset markets, inequality widens, wealth concentrates among asset holders. Political tension rises. If credit shifts toward productive investment, infrastructure, innovation, human capital, long-term growth improves, and debt becomes easier to service. The wiring can change, but it doesn't change automatically. It changes when incentives change, when regulation shifts, when risk pricing adjusts, when public tolerance for asset bubbles declines. Until then, credit will keep flowing where it feels safest. And safest, in financial terms, often means existing wealth. So the next time you hear that an economy is booming, ask a different question. Is income growing, or is credit growing? Because those are not the same thing. One reflects production. The other reflects balance sheets. And balance sheets, when stretched too far, don't break loudly at first. Quietly. Credit is not just money borrowed. It's a steering mechanism. It decides which sectors expand, which prices rise, which generations carry the burden, which countries gain leverage,